Because this property is Airbnb'd, you can likely qualify for the short-term rental loophole. I want you all to write this down. Short-term rental loophole. It is the coolest IRS loophole I have seen, I think, ever in my career, because these did not exist when I first started in tax. But now Airbnb and like short-term rentals are a big thing. And this is the best tax hack ever.
Welcome to Life-Changing Money, a podcast all about one of the most taboo topics in the world, money. I'm your host, Barbara Strehans, and we're going behind the scenes on business owners' journeys to money, success, and wealth. Let's get started. Hello, and welcome to another episode of Life-Changing Money. I am so excited for this week's solo episode. It's going to be on all things real estate tax strategies. So whether you want to buy properties, sell properties, you have short-term, mid-term, long-term rentals, this episode is for you. So what we've done is we took all the questions that we got from our Write Off Your Real Estate course launch last year, and we compiled them, organized them, and we're going to answer your questions here on the podcast today. And just as a reminder, we're relaunching Write Off Your Real Estate. The masterclass is going to be on May 1st at 10 a.m. Pacific. And so the link will be in the show notes here, but also on any of our social medias, you can comment real estate and we'll send you the link to our free masterclass. I love this course so much when we relaunch it because I compiled every single tax strategy I've seen in the last 15 years when it comes to real estate. So we all know, we've all heard, real estate is the best way to save money in taxes. And I'm showing you exactly how in the course. Like, it's not just the what. I think we've all purchased courses before and we buy them, we open them, and we're like, this is so surface level. I could have Googled this. Like, it's telling me the what, but not the how to do this stuff. I think too many people gatekeep when they come out with courses because they just think people maybe won't buy their actual services. And I just don't think that that's true. And that's why our courses are so successful and why our launches are so big is because everyone tells all their friends how amazing our courses are, and they keep buying them whenever we come out with new ones. And so when we relaunch this course, May 1st, 2025 at 10 a.m., we're adding modules to it. We're adding even more strategies that I have kind of come up with over the last year when we relaunched it last time. And so it's always just fun to record new strategies, new ways for people to save money. So let's dive in to some of the questions. Let me grab a sip of coffee first because I have not had enough for today. And I'm just going to tell you guys, in case you see my face looking weird if you're watching it on video, because this coffee tastes like crap. Someone drank the last of the creamer and didn't rebuy any. Does that ever happen to you guys at home? So I'm drinking coffee without creamer, which is terrible, but probably healthier for me. Okay, the first question. I live in a house hack, which if you guys don't know what a house hack is, house hacking is basically just you're living in a house where you're also renting the rooms out. Or you're in a duplex, triplex, quadplex, and you live in one, and then you rent out the others. So there's kind of two ways to house hack. So this person's question says, I live in a house hack. Would that be a better write-off in an LLC rather than personal taxes? Okay, I love this question because it has a really common myth in there. A lot of people think that having an LLC is going to save you money in taxes. And remember, an LLC does not save you $1 in tax. Whether you have an LLC or not, the amount of taxes you're going to pay on your tax return is the exact same thing. But this is why people get LLCs, not for taxes, but
for liability purposes. And that is the definition of an LLC. LLC stands for limited liability company. So when you open an LLC, it's going to limit your liability in case you were to ever be sued. So when you live in a house hack, meaning let's just use the example, you own a primary residence and you rent the others out, you might want to have an LLC that owns the property in case the other people that rent the other rooms somehow get hurt in the property. We've had clients, like so many crazy stories. We've had clients that their house ended up having mold in it. And so the other renters like sued them for medical expenses. We've had people that someone's tripped on a rock or like a broken step or a paver or something crazy on the property. And so they sue them for damages. Just all kinds of things. And we wouldn't ever think that that would happen, but you literally just never know. And so I always would rather have someone have properties in an LLC than not. Now, it will also depend on certain states that you live in because, for example, California charges $800 per year for the LLCs that you own. Is it worth it to you if this person had a house hack in California to pay the $800 a year plus extra insurance, setting up the LLC, all of that? Maybe, maybe not. For a lot of our California clients, they will have like multiple properties in one LLC so that they're not having to pay that $800 franchise tax fee every year. But in other states, it's a lot less to have your LLC. Like Arizona, I think $200 to set it up and maybe $25 or $50 a year. I forget because my husband does all that for me. Some states, it doesn't really cost you anything every year. Some states, it's like $125 to set up. So it's really going to depend on the cost for you in the states that you live in. But also remember, to me, I don't really care what the cost is. I'm going to want to limit my liability, especially as the amount of assets that you own go up and up and up all the time, right? Because this person, they might live in a house hack now, but they're doing that so that they can buy more investment properties later because they're saving money on rent. Like they are probably having their entire mortgage paid by the other renters. So since the other renters are paying for their mortgage, they can save more money every month and buy another investment property sooner. So this person will probably eventually have more assets. So you're going to want even more liability protection. Again, this is not legal advice. I'm not an attorney, but I'm just telling you what I've seen in the 15 years of being a tax strategist, of being a CFO, accountant, like doing all these things for our clients and for ourselves. And I've consulted and paid so many attorneys ourselves. I can tell you what likely they will say as well. So is it a better write-off in an LLC than personal taxes? No. Remember, you're going to pay the same amount in taxes either way. But you might want to think about it for liability purposes. You're also going to want to make sure that you have a really good umbrella insurance policy, which just means an umbrella policy is like an extra coverage, like an umbrella over you in case it rains, where you get extra insurance coverage on top of your normal insurance coverage. Next question. If you only have one rental property, should it be in an LLC? Or what are permittable expenses? Well, based on the answer to my last question, I bet you guys can decipher what I'm going to say on if they only own one rental property, should it be in an LLC? I think that it should, for sure. Someone just yesterday in my mastermind group, I host a mastermind group twice a year called the Council Mastermind, and it's for business owners that want to scale to 7 figures or to real estate investors that want to get more properties. And one of them put an offer in all cash on a foreclosure, and they'll get a mortgage on it later. This is a great strategy for if you just want the property quick and you know you're going to have the best offer. So they put in a cash offer, they have the cash for it, they'll get the property, and then once they, someone moves in or whatever, they'll get a mortgage on it, meaning they'll just get their cash back minus the down payment that they put in. So let's say the property was 150K. So they'll pay cash 150K. They'll get someone in there quickly and then get a mortgage out for probably 75%. So let's say on 150, we have 15, that's 30. So 42,500 is probably their down payment. So they'll get $110-ish thousand back from the 150 they paid cash. And it's just a way to, like, a cool strategy to get the properties, especially if there's like a lot of people bidding on it, a lot of investors interested. People want cash offers because they know it's going to close quickly. Anyways, their question was, since we're purchasing this within like 5 days, do we just buy it in our personal name or do we buy it in an LLC? And I said, buy it in the LLC for sure. I mean, these people are high income executives, W-2. They have a lot of assets. They could be sued for a lot of money. And so I said, just open the LLC now. You're going to contribute the money to the LLC. So let's use their example. Let's say the property was 150K. So they're going to take 150K of their personal money, put it into the new LLC bank account. So within those 5 days that they're closing, they're going to have to open the LLC. They need to get an LLC bank account and they need to transfer those funds into the LLC bank account. The LLC will then buy the property. And then all income and expenses will come out of that LLC as well. So likely they're going to have to transfer, let's say, another 30K into that LLC bank account, and that'll pay for all the expenses. This particular property needs a lot of work, a lot of rehab. So they're going to use that bank account for all the expenses, because remember, you don't want to commingle your personal accounts with business accounts or LLC accounts or rental accounts, whatever it is. So yes, open the LLC quickly. And yes, I think the rental property should be in an LLC, even if you just have one property. And yes, even if you have really good insurance coverage, and yes, even if you have umbrella insurance coverage, I just think it's the safest way to go, because we all work so freaking hard for the money that we make and the profits that we keep, because we all know it's a lot less than the money we actually bring in. And so you're using your profits to buy these rental properties. The last thing I would want is for anyone to get sued for any reason and have to lose more assets than they needed to. Their second question was, what are permittable expenses? I mean, I could just go down an entire rabbit hole here. The Write Off Your Real Estate course lists literally every single expense you could ever think of for a rental property. And our Write Off Your Real Estate Masterclass will also list some of those and kind of bring more to light that you might be missing out on. So for sure, just click the link below for the free masterclass on May 1st. And also know that the course will be launching on May 1st as well. The cool thing is, if you are one of the first people to purchase the course, like live in the masterclass, you also get a mastermind call with me and one of my favorite lenders who I use all the time. We did this last year and it was so fun. We broke you up into like groups of 12. So groups of 12, we all hop on a Zoom call and you can dive as deep as you want, tell us as much as you want about your scenario, how much funds you have, how many investment properties you have or don't have, and just say, hey, like, this is my scenario. How can I get more properties? And we all come together and think of ways that you can get properties faster. And last year when we did this in the mastermind calls, so many of you were able to buy investment properties since the last time we launched. It's so cool. We had this really young couple that they already owned their primary residence, that they were able to turn that primary residence into a rental, and they were able to buy another nicer, bigger personal residence for themselves. Like, how cool to be in your 20s and be able to do that. We've had people that were able to pull out HELOCs that they originally either thought they couldn't qualify for, they thought the rates were going to be too high and that it wouldn't make sense. And so we've had people pull out HELOCs they didn't think that they could get so that they could build an ADU on their property, which just means like basically another rental property on their own personal residence property. We had someone get a HELOC that was able to just purchase more investment properties. Like one couple got a duplex, another couple bought this property with a ton of acreage on it that they're able to put 3 more dwellings on, which is really cool. We've had other people go in with their family members, like their kiddos or their parents, to buy more properties. It's just like really awesome, these mastermind calls, because we, like myself and my preferred lender, we've just seen it all in every scenario and every which way to get more investment properties. And so we just give it all to you in that mastermind call, and you're able to just execute it. Like, it's so cool. So you get that when you purchase live during the masterclass. So definitely be on the masterclass live for sure, because that call is like priceless. I don't even know like what that would cost in a normal setting. Like, it's not even offered anywhere. Like, where else have you heard of a tax strategist and a lender being willing to hop on a call with you for like 90 minutes, and you get to hear other people's scenarios so that your mind is just like bigger and open to new scenarios and situations, and hear what other people are doing so that you're like, oh my gosh, I could do that too. It's literally priceless. We don't offer it any other way. So the permittable expenses, definitely in the Write Off Your Real Estate course, because there's just so many. But don't forget, like when you have rental properties, you can write off all the travel to those properties. You can travel to different markets and research new houses, new markets, new properties. You can write off a vehicle in your rentals. Like some of you might need new trucks because you're doing a lot of rehab or construction. And so you have to have a bigger car in order to do that type of construction. You can definitely write off home office expenses. Like a lot of investors forget that, hello, you're doing all your work, like finding the properties, analyzing the properties, giving your lender all the documents they need. You're doing all of that at home. So take your home office deduction. Next question, after I sip this really yucky coffee. Okay, I'm going to buy a house for a rental. Great, congratulations. Do I need to set up an LLC first? Okay, everyone's asking a very similar question. Yes, I would. I'll move on to the next question here. We have a cabin. I really want a cabin. I was just talking to my friends about this. I want a cabin. Matt wants a cabin. He wants it in the mountains. I want it like butted up against water. So like a lake or a river, probably not a pond. Like that's too small and like sounds smelly and like buggy to me. So if anyone has suggestions, DM me on Instagram for like a cabin-ish house on a lake, also in the mountains, not a lot of bugs. Is this too much to ask? Maybe there's always bugs by water, but mosquitoes love me. So I would prefer if there's not like a shit ton of mosquitoes. And I want to be able to like water ski in the lake. If you guys didn't know, fun fact, I used to be a professional water skier when I was in my teens, slalom water skier. And so I just like love when I'm on a lake. Okay. So we have a cabin, which is paid off and turned it into an Airbnb last year. Okay, great. Can we deduct all improvements made to the property? Okay, here's what I would do based on this scenario. It's not even the question they're asking, but it's what they said. They have a cabin, which is paid off, and they turned it into an Airbnb. Here's what I would do. I don't love paid off properties. And here's why. Again, I paid an attorney to tell me this. And they said they don't like paid off properties either, because when you're sued, the first thing people look at is what assets you have. And if they see an asset like this one, which is a cabin, which is paid off, they're like, sweet, we can sue them for the fair market value of the cabin. Let's just say the cabin's worth $500,000. And they can sue you for the fair market value. Now you'd have to sell the cabin, or, you know, like, I don't really know how that works, but if you were sued, I think maybe the courts sell the cabin, or the banks, or I don't know what it is, but they'd sell your cabin and give the person the cash that they sued you for. Whereas if there's a mortgage on it, it is not worth $500,000. It is worth $500,000 minus the mortgage that you have on it. So let's say you have a $400,000 mortgage on it. Well, they could only get $100,000, not $500,000. So it looks a lot less attractive to the person suing you because there's a mortgage on it. i.e., you want to always have mortgages on your properties as long as, it makes sense financially, the rates are reasonable, and you're making more money than the interest you're being charged on the mortgage. But let's say in this scenario, the $500,000 cabin, you could likely get a mortgage for $400,000. And right now, let's say the rates, you could get one at like 6%. I just refinanced a 5-unit, like it's a commercial property at 6.1 something percent. So for sure, a residential property you could get for lower. So let's just assume 6%. That's a great rate. And since it's being Airbnb'd, it should be far outweighing the mortgage that you're having to pay. So let's say on that Airbnb, it's bringing in $10,000 a month. Well, let's assume the mortgage, the insurance, the property tax, all of that costs you $5,000 a month. Well, you're still pocketing $5,000 of the $10,000 it's bringing in. And what's really freaking cool is you just got $400,000 in your bank account. Literally, the bank, the lender, just wired you $400,000 into your bank account that you could go out and buy. If you had $400,000, you could buy $1.6 million worth of more property. And that $400,000 is tax free. It's tax free because it's a loan. Loans are not taxable. It's like the best thing ever. So don't have paid off properties. Take out mortgages, take out HELOCs if it makes sense, because you can buy so much more properties faster. Like, oh my gosh, this scenario is so cool. I wish I had a cabin that was paid off that I could then get $400,000 in my bank account and buy more properties with. And on top of that, another benefit is the interest you're paying on that mortgage is a deduction to the Airbnb. So it's basically a business deduction. Hello, amazing, so cool. Back to their exact question though, can we deduct all improvements made to the property? Kind of is the answer. You don't deduct it. It's called depreciation. So with this scenario, what I also want you to do, Mr. or Mrs. Paid Off Cabin, who needs to get a lot more cash, reach out to me and I'll send you my preferred lender who can help you with this. But you're also going to want a cost segregation study because this property is Airbnb'd. You can likely qualify for the short-term rental loophole. I want you all to write this down if you're listening. Don't write it down if you're listening in the car. But short-term rental loophole. It is the coolest IRS loophole I have seen, I think, ever in my career, because these did not exist when I first started in tax. But now Airbnb and like short-term rentals are a big thing. And this is the best tax hack ever. So because this person has an Airbnb, you want to make sure your average stay is less than 7 days. Meaning, if you have someone that stayed for 10 days and you had someone that stayed for 5 days, your average stay is going to be 15 divided by 2. That's 7.5. You don't want that because you didn't just hit the rule. You want a 10-day stay and a 4-day stay. That would be 14. Now 14 divided by 2 is 7. Okay, so what I tell a lot of my clients on Airbnb, make your max stay at 10 days because you'll have people that say 2 or 3 days, 4 days, and that'll make your average lower, lower, lower. You just want to make sure your average stay is less than 7 days. And if it is, and you spend 100 hours on the property a year and more than anyone else, you're going to spend 100 hours going there and checking on the property. You're going to go there and spend 100 hours cumulatively on pulling weeds, on fixing the toilet, on putting up new artwork, whatever it is that you need to go and fix and check on at your Airbnbs. Maybe you're the one managing it. So you're messaging with the tenants, with the people staying there. You're letting them know the lock code. And when the toilet clogs, you're sending out the plumber. And when they break a vase because they were partying too hard, you're working with Airbnb to get that reimbursed. Whatever it is, you're going to spend 100 hours a year, which is not that much on an Airbnb property. So 7 days or less for your average stay and 100 hours for the year, you just met the rules for the short-term rental loophole, which is so important for everyone listening for their taxes, because whether you're a W-2 employee or you make $10 million in your business, or you make $100,000 in your business, or you're an executive or you're a teacher, whatever, you get to take your real estate losses against your income, which is not the case for everyone, but it works if you have a short-term rental like this person with the cabin Airbnb. So it's so important to get a cost segregation study, which we do. So you can DM me on Instagram at Your Tax Coach, or you can go to our website, yourtaxcoach.com, or you can schedule a call with us, yourtaxcoachscheduling.com, and we can tell you what we would estimate for a deduction that you would get on your tax return from doing a cost segregation study. Because what this will do, let's use this cabin example, $500,000 cabin. You could get $125,000 to $200,000 in extra deductions on your tax return by doing a cost segregation study, which is basically just accelerating the depreciation that you have on your investment properties so that it can offset your other income. It's so cool. It's so beneficial. Not everyone knows about these. Not even real estate agents know cost segregation studies. It kind of blows my mind. So, can you deduct all the improvements made to the properties? Yes, it's going to be through depreciation, and it's going to be through when we do a cost segregation study for you. You have to have a CPA firm or an engineering firm perform these cost seg studies. And then obviously your accountant is going to put that cost seg study on your tax return correctly, hopefully for you when it's tax time. And no, you don't have to do the cost segregation study in the year that you bought the property. If you're listening to this and you're like, oh my gosh, I should have done this 5 years ago when I bought the property, you can still do it now. And actually you should do it now, because I have seen where the IRS, if they come in and audit your rental and they see you have not taken depreciation like you should have, i.e. a cost seg study, they take the depreciation from you and you can never take it again. It's kind of wild. So yes, you can deduct all improvements made to the property. Okay, last question for this podcast episode. We definitely have a lot more questions, and feel free to DM me your real estate questions, because I will answer them for you, whether it's in a podcast, it's on the Write Off Your Real Estate Masterclass. I will answer it for you somewhere. So make sure to DM it to me and sign up for the Write Off Your Real Estate Masterclass. But here's the last question. I have an LLC for real estate rentals, great, and house flipping. Okay, I hope it's not in the same LLC. Just reading that. And a sole prop for logistics. Can I double the office deduction by applying it to each business? Okay, great question. We get this all the time. But before I get to that question, this person says they have an LLC for rentals and flipping. Let me tell you, if you are out there and you do rentals and you flip, they should 1,000% be in different LLCs. Because your rental real estate, in the eyes of the IRS, is looked at as passive income. I can go into passive income in another class, but just know that typically rental real estate is looked at as passive, and house flipping is looked at as active, meaning it's a business for you. House flippers, they'll do multiple houses a year, or they'll do one a year. It requires a lot more of your time than long-term rentals. And so the IRS looks at it like a business. And so you're taxed at the ordinary tax rates, meaning, up to 40% when you're flipping houses because it's business, plus another 15.3% in self-employment tax if you don't have an S Corp. So for sure, if you're house flipping, talk to us, see if it makes sense for you to be an S Corp, but definitely at least have it in a different LLC. Also for liability purposes, because if like, let's say a contractor slips and falls from the roof when they're redoing the roof for you on the house flip, they could sue you and get your rental real estate if they're in the same LLC. So don't do that. Okay. So this person hopefully is going to break out their rental real estate because it's passive and their active house flipping income into 2 LLCs. Now, they also have a sole proprietorship for logistics. Here's the other thing with that, and you've heard me talk about this whole time. They also need an LLC for that logistics company because when you're a sole proprietor, you are not protected at all if you were to be sued. So I hope this person, after listening to this, is going to have 3 entities, one for rental real estate, one for house flipping, and one for their logistics business. In addition, I don't like sole proprietorships because the IRS looks at them like a hobby. The IRS sees a sole prop and they're like, oh, this person just willy-nilly started a business, didn't get an entity, didn't get an EIN number, didn't get bank accounts, didn't think it was going to do enough money to even like pay an attorney to get an operating agreement, to do things the right way. So it's probably a hobby and they're just trying to run losses against their other income. And so sole proprietorships are audited 35 times more than partnerships and S corporations. It's so crazy. Like, please don't do business in a sole prop for auditing purposes. I have been through audits for clients. It is terrible. It is time consuming. It's so expensive. So try to avoid it as much as you can. But to their question, can I double the office deduction by applying it to each business? No, you cannot. There is no double dipping in taxes. But what you would do is bifurcate the home office deduction. So let's say in total, your home office deduction was $10,000. I'm going to say you're going to trifurcate it because you're going to have 3 LLCs hopefully after this. So you're going to give a third of that $10K to the rental real estate, a third of that $10K to the house flipping business, and a third of that $10K to the sole prop logistics business that is now hopefully an LLC. But you cannot double dip. The only time, I guess, it wouldn't be called double dipping, but if you had 2 home offices, so sometimes our clients, if they're married, one spouse has one home office, one spouse has another, then, you're kind of taking double the amount of home office deductions. So those are our real estate questions answered for today. I have so many more that we can answer and so many scenarios to dig into, and I'm so excited. Let me know if you love these. And if you do, send your questions my way on Instagram at Your Tax Coach so that I can answer your questions in a future podcast and in our Write Off Your Real Estate Masterclass. Again, we only do it once a year. So if you miss out, you're going to be so sad because you could have more investment properties by this time next year. Comment real estate on any of my social medias and it'll send you the link as well as in the show notes here. So thank you so much for listening. I'll see you next time.
Thank you for listening to this episode of Life Changing Money. Don't forget to subscribe, and I would love if you left a review and shared it with your friends. See you next time.